Today I'd like to talk about financial ratios. What financial ratios are a way of assessing information from the balance sheet and income statement in a very quick and meaningful way. Because the balance sheet and income statement can be kind of complicated. There's a lot of information there, and it's kind of hard to see just at a glance what the status of the company is unless you have a lot of experience. And the financial ratios allow anyone to assess very critical information fairly quickly. What these are just a number of little calculations you can do, taking information from the balance sheet and income statement. I'll be discussing, I think, 5 of these, 5 fairly common ones. First one I want to look at is the current ratio. The idea behind the current ratio is that we know from the balance sheet the current assets and current liabilities. If you recall, the current assets are assets that can be converted into cash within 1 year, and current liabilities are the liabilities that have to be paid off within 1 year. Because we have those two figures, we can see how much danger the company is in of running out of money over the next year. Because if the liabilities, the current liabilities exceed the current assets, you can't pay off your debts. And the margin by which the current assets exceeds the current liabilities gives you a measure of how secure you are in terms of your cash flow. So the current ratio is simply the current assets divided by the current liabilities. That obviously you want that to be greater than 1, and the larger than 1 it is, the better. So for our Waterloo Fabricating example, the current assets would be the sum of these 5 figures. The current liabilities is the sum of these 3 figures. And that works out to be $52,340 divided by 42,955. And that's 1.2. At 1.2, we can see it exceeds 1. So that critical threshold of 1 has been reached. But actually, the guideline our desirable number is 2. You want your current assets to exceed your current liabilities by a factor of 2. So the closer that is to 2, the more secure you are. This is awfully close to 1, and there is some question here. And the question arises because you don't have complete assurance that you're going to be able to sell all of your inventory. You don't have complete assurance that all of your creditors are going to pay you, and so forth. So 2 is desirable. And Waterloo Fabricating hasn't reached that 2. Now, another measure of the security of cash flow is called the acid test ratio. And the idea here is that inventories in particular are things you can't really be too sure of. There's lots of firms that have thousands or tens of thousands or hundreds of thousands of dollars worth of goods in their inventory that they'll never sell because they're out of fashion, or people just don't want them. And they're stuck with these inventories that have value on paper, but they can't really be converted into cash, even though they appear in the balance sheet as being a current asset. So what the acid test ratio does is it looks at the more secure aspects of the current assets, which are essentially cash. And accounts receivable as well. So if we do this acid test ratio from our balance sheet, what we're looking at is the cash and accounts receivable and ignoring all of these inventories, considering the raw materials, work in progress, and finished good all of being inventories in this case. So we're looking at the $23,103 cash plus $9,574 accounts receivable divided by the current liabilities of $42,955. And the figure there is 0.76. Here, the figure of 1, having your current assets minus inventories being equal to or exceeding your current liabilities, is a target to aim for, and we don't have that. So if in fact our inventories aren't sold, we would put in a position of having to pay back money we don't have, either paying it back to the bank or to our suppliers or so forth. And that could drive us into either bankruptcy or having to sell assets that we wouldn't normally sell, our equipment, our land, our building, or something like that. So the fact is less than 1 is desirable, means that this company has some concerns about its cash flow, and it could be put into a dangerous position, depending on how well it can sell its inventories. Now, next one to look at, called the equity ratio. The idea behind the equity ratio is that all of our assets are paid for from 2 sources, either equity or debt. Equity is a fairly secure resource because stockholders don't generally and can't take the money out of the company because they want to. Or retained earnings as well is something that the company has complete control over. Whereas debt, you're always at the mercy of the person or organization holding your debt. A creditor can demand payment right away. A bank can call the loan or so forth. So the company loses control over its business by being in debt. And the more debt it has, the less control it has. So the equity ratio measures the proportion of all the money the company has, which is equity. And the larger that is, the better, because then the company's less at mercy of its creditors. So total equity divided by total liabilities plus equity. Because of the balance sheet balances, total liability plus equity is also the same as the total value of the assets. So for Waterloo Fabricating, the total equity is this capital stock plus retained earnings of some $95,000. The total liabilities plus equity is $288,000, same as the total value of the assets. So our ratio is 95,475 over 288,430, which is equal to 0.33. So this says that only a third of the value of the company, the total of liabilities plus equity, comes from equity. 2/3 doesn't. And that's high. The target is 0.75. So we're much more at the mercy of our creditors, or sorry, this company is much more at the mercy of their creditors than is desirable. They could be put into receivership, which means that they go bankrupt at any time if the bank should call a loan or something like that. It's a dangerous position to be in. So that's the equity ratio. Inventory turnover. What the inventory turnover does is measures how quickly the inventory is sold. And the value in doing so is it can tell an analyst whether the amount of inventory that the company has at a particular point in time is very large or very small. And the best way of judging this is with comparison to other similar companies. Now, the ratio is net sales over inventory. Now, the inventory in this case is not all the inventory, but just the finished goods. So the inventory is the $11,000. The net sales is, in this case, not net income from sales as appears on the income statement here, but actually gross income from sales. Now this can be confusing because we're using the term net in 2 different ways. Here we're using net, meaning less cost of goods sold, whereas in the ratio, the net means taking into account returns and discounts and so forth. Now, there's no excuse for this confusion other than the fact that these ratios are defined in a particular way. And whenever one uses a ratio, one has to look very carefully at what's meant by the terms net sales and inventory. And when you see these ratios used, they're defined fairly precisely. So things like net or inventory have loose meanings. Sometimes inventory can mean everything from raw materials to goods on the shelf. Sometimes it can mean only finished goods. Net, the word net just means that some process has undergone the thing that it modifies, and that process has to be defined. So point is, when you look at a ratio of any type, and there are hundreds of these things, not just the 5 I'm talking about in this course, you have to look exactly how the term's defined to know what figures to take from the balance sheet and income statement. So the correct figures here for net sales are the gross income from sales of $241,200, and the correct number for the inventory is the finished goods inventory of $11,440. And the answer is 21. It's 21 per month, because we're actually using information from both the balance sheet, which is a point-in-time piece of information, and the income statement. This gross income from sales, which is the net sales used for the ratio, is over a month. So the inventory turnover is 21 times per month the inventory turns over. So we have a certain amount of inventory in the company. We have a certain amount of sales. We must have sold that much inventory 21 times this month to make that many sales. Now, Waterloo Fabricating is in a particular category of business, and one can find tables that list averages for that category of businesses. And if we check the fabricated structural metal products category, we can see that on average, companies like Waterloo Fabricating have an inventory of 0.5 per month. So similar companies report an inventory turnover of 0.5, which means they tend to carry a lot of inventory compared to the sales, whereas Waterloo turns over inventory 21 times per month. This is a very unusual situation. Either Waterloo Fabricating has a very unusual product compared to other products produced by similar companies, or they've sold out their inventory. They have very little inventory. And that can be very important, because that means that it may be very difficult for them to meet current orders. So the inventory turnover figures give you this information, and they give it to you in a way that doesn't perhaps give you the exact answer, whether this is really a problem or not, but point in the direction of where to look to find information to find out whether it is a problem. The last ratio, or actually a pair of ratios I want to talk about, is the net profit ratio. This is simply a way of measuring how profitable the company is. It gives you a figure kind of like interest. There are two of them depending on how you want to look at it. Profit after taxes over total assets, or profit after taxes over net worth. Net worth is another term for equity. The idea is that the company can be viewed as an investment. You're investing all your assets into a process of making money, and the money it makes is the profit. Or another way of looking at it, because a lot of the money is borrowed, you're really only investing the equity, the net worth. And with that as leverage, as a means for getting debt, you raise debt. You raise liability capital to make your profit. Now, both of these have validity in terms of what you're investing and what you're earning, which is why we have both of them. But they have to be kind of interpreted in context to judge whether your return on investment is a reasonable one. So to get these figures, it's fairly straightforward. For profit after taxes, we look at the income statement, and we have the $2,000 figure. For our total assets, we have that $288,000. Or our net worth is the same as equity. It's the $95,000 sum of the two equity components. So with respect to total assets, we've got 2,378 divided by 288,430 is it's 0.82%. That's per month, though, because our income statement was over a month period. To find the interest per year we're earning, we have to convert that to a yearly rate, and it's 9.9% per year. With respect to net worth, it's the same profit of $2,378, but divided by our total equity of $95,475. That's 2.5% per month, or 29.9% per year. Now, either way, whichever one you look at, that seems like a reasonable profit. And that's how you have to view this, just like you would any other investment. That's how to interpret these figures. So if we take the Waterloo Fabricating situation in general, we can see we have a company that is profitable this last month. There's no doubt about that. But there's some questions about that profit. In the first place, we know they've got serious problems with the cash flow because they may be in trouble over the next year meeting their liabilities. We know they're too dependent on debt. And we know there's something very peculiar happening with their inventories. They may have sold out all their inventory and be unable to meet future inventories. And we've been able to tell all this information very quickly using these financial ratios. And you can do this with any balance sheet or income statement. And it gives you that way of getting some very critical information very quickly. And they're very useful tools for examining the financial status of a company. Now, in engineering decision making, this is exactly what you want to do. You look at the balance sheet and income statement of the firm, you determine the financial ratios, you get a vision for what the company is doing, and then you use that information in a broad way or a specific way in engineering decision making. In determining, for example, what a MAR should be, because that's, in a situation like Waterloo Fabricating, your MAR should be fairly high because money is tight. And depending on the circumstances, a variety of information that can be used in general in your engineering decision making. Thank you.